Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. Earnings season, ramp it up, especially with big tech on the horizon. We've got the scorecard so far, plus a look at whether we could see market gains expand beyond tech. One of those companies reporting, Procter Gamble, the consumer giant, beating revenue estimates thanks to higher prices. A conversation with the CFO is ahead. And a deep freeze and major winter storm expected to churn its way across the U.S. And as a result, natural gas prices have been soaring. We've got the very latest. Well, markets have juggled a diplomatic tightrope this week, but let's not forget, also need to navigate earnings season now in full swing. Ines Ferré now joins me for the Investor Playbook. Ines.
Yeah, Josh, and Wall Street is setting aside any geopolitical drama, and they are focusing on earnings, which is what really drives the market higher. And you have the estimates for the S&P 500 that are expected the earnings growth to come in at 8.2% for the fourth quarter. But FactSet analysts are saying that that could be over 14% when all is said and done, because over and over again, we're hearing about the fundamentals. Richard Saperstein, Chief Investment Officer at Treasury Partners, spoke to Julie Hyman and talked about the fundamentals. Take a listen.
When we look at the fundamentals, which is declining inflation, a robust economy, we've got excellent jobs. Jobs are moderating but growing, but we've got an excellent backdrop for earnings growth.
And BNY Wealth also had a roundtable this week, and I attended that. And they talked about the fact that you are going to be seeing a broadening of the market, and that you are going to see participation not just from the top 10 stocks, companies of the S&P 500, the Mag 7, but also from other sectors. And that's part of what we've seen also with the stock market year to date, when we've seen materials that are higher, industrial higher, energy higher. So you're looking at that cyclical play, and that is good because that means that it's not just the concentration when it comes to tech. But of course, strategists are enthusiastic about tech, about AI. That's still a driver of productivity. That's a driver of higher earnings for companies. And one other note to make as well is that the incentives of the Big Beautiful Bill, those are expected to really be seen this year, because those incentives for CapEx also, that's when all is said and done, expected to lower the tax rate for corporations by about 3%, according to some estimates. So that goes to the bottom line of a company as well. Josh?
Ines, thank you. Well, Mag 7 stocks surging again, led by Meta and Tesla. And Yahoo Finance's Jared Booker is breaking it all down in this installment of Stocks in Translation.
Here is the big question in this AI-driven bull market. Now in year 4, is this still a starters-only rally where the mega caps do most of the work, or is the bench finally scoring? Relative strength is one of the cleanest ways to check that, and that's what we're digging into in today's Stocks in Translation. Now, relative strength is simple. You take one price and divide it by another price. Do that for each day's close in 2 different markets, and you'll get one line that goes up, goes down, or goes sideways over time. If it rises, the first market is outperforming. And when the line falls, that means that the second market is winning. Sideways is a tie. And once you get that, you can use it everywhere. So here are a few quick examples, all using different ETFs. You can divide consumer discretionary by consumer staples, XLY over XLP, for risk on versus defensive. Or look at the S&P 500 over the Russell 2000 for large cap versus small. High-yield corporate bonds over U.S. Treasuries for risky credit versus safe credit, and even gold versus silver to gauge a flight to safety versus an uptick in industrial demand. But today we're going to use this tool to see if this bull market is still being carried by just a few giant names, or if it's finally broadening. And we're going to use here America's benchmark stock index, that would be the S&P 500, but taking two different calculations. So on top, we're going to use the market cap weighted version where bigger stocks get more votes, and we're going to divide that by the equal weighted version where each stock gets one vote. The result is that line you see. And when it goes up, the biggest stocks are doing more of the scoring. When it goes down, most of the or more of the index is participating, using the bench. And this chart goes back to 1990, and you can really see the dot-com boom and peak right there. That was a peak concentration, and it was a steady decline into 2010 right here as the rally became much broader. Now look at the last few years that I'm circling here. It's been trending up again, which fits the Mag 7 dominant story. And we recently talked to Horizon's Chief Investment Officer, Scott Ladner, on stocks in translation. Here's how he framed it.
The past couple of 3 years has been all about the building of AI capabilities. That's where the Mag 7 really matters, and so they've outperformed. But these next couple of years are going to be about diffusing AI throughout the entire economy. Then the other 493, or the rest of the economy, the rest of the stocks, can start to participate because they're going to start using this great tool for productivity enhancements.
Translation, the first phase was building the tools. A few companies did the heavy lifting. The next phase, using the tools, and that's what you can get more players on the scoreboard. Now let's zoom in because this is where the story turns into a real-time signal. And what we're showing here is the last decade. And you can see a slow rise into 2010 into 2020 when we had some wild swings over the pandemic. That's when leadership was changing wildly. And over the 2022 bear market, both indexes were going down. But the giants, the starters, they were sinking faster. So the line trended down until the AI bull market and the era of the Mag 7 was born. And that's what I'm circling right here. The line has risen sharply, and it hasn't been straight up. You can see some decent pullbacks when the mega caps stopped leading for a bit. But remember, this is about relative performance, one market versus the other. Here's Ladner again.
I'm certainly not calling for NVIDIA or Mag 7 or any of these big mega cap names to go down. All they have to do is just sort of tread water, or the other ones outperform.
And that's the whole game. You don't need a blow up in the starters, you just need the bench to contribute. So if you're watching for a broader rally in 2026, the question isn't only what NVIDIA and Tesla are going to do tomorrow, it's whether more of the S&P starts putting on points onto that board. So let's get one more actionable bite from Scott about what to expect in 2026.
Specifically within that 493, we like cyclical plays. Those are the types of industries and stocks that we tend to like right now because we do think we're going to get, at least for the first half of 2026, a really kind of run it hot type of scenario.
Run it hot. So keep an eye on the parts of the market that tend to benefit when growth picks up. Think industrials, retail, and banks. Bottom line, this ratio is your breadth scoreboard. If it flattens or falls, the rally is actually getting healthier. And if you change the ticker inputs, you can make your own custom scoreboard. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Natural gas prices spiking ahead of that massive snowstorm that's expected to hit the East Coast this weekend. Our very own Jake Conley joins now with the latest moves. Jake, what are you seeing?
Yeah, natural gas, Josh, has been spiking really hard on this cold weather snap that's coming through, all the snow that's coming through. Over the last 5 days, you saw prices on the futures market get up to 75% jump. That's the biggest jump on a 5-day session since 1990, 30 years, right? Mm-hmm. Now that's pared back a little bit today to about a 55% jump on the 5-day, but still huge movement. You also see EQT and Taro, these natural gas companies, also jumping just on the fact that that product is going to be so in demand.
Why do prices spike during storms like this?
Yeah, it's not the snow, it's the cold weather. Mm-hmm. You got to remember, natural gas is the predominant source of heating fuel for the US. It also supplies a lot of the electrical power. And so when there's a lot of cold weather, what do people do? They turn their heaters on. They turn the heater way up. That's pulling natural gas off the market into power plants that's then going to go out to your home. The problem with natural gas, why it spikes so hard, is that you can only move it by pipeline. And there's not a lot of pipelines in this country. The infrastructure has largely lagged behind demand. So you get really tight capacity constraints. And now you've got data centers, right? Also trying to get some of that natural gas even more constrained. So that when you get a storm like this, you've got kind of a perfect storm. A lot of demand from the consumer side, demand from the industrial side, and then traders are going to look at this weather and say there's going to be a ton of demand coming down the pipe. We need to buy, and that's going to shoot prices up because the capacity is maxed out. More demand, but there's nowhere for it to come from.
All right, big storm coming. Jake, thank you, sir.
Thanks, Josh.
We're taking a look at some stocks moving in the after-hours trade. Shares of Capital One under pressure. The company reporting fourth quarter earnings and a big acquisition expanding into the credit card space. Capital One buying Brex in a cash and stock deal for just over $5.1 billion. Brex's business is centered mostly on corporate cards, expenses, and rewards. The bank's adjusted earnings missed Wall Street expectations. Alcoa shares getting a boost on fourth quarter results, earnings, and revenue topping Wall Street's expectations. The company's benefiting from rising aluminum costs, which are offsetting the hit from tariffs. President Trump's trade policies have helped drive prices higher. The import duty on aluminum jumped to 50% in June 2025. Stick around, much rash for a trend. That's still to come. Procter Gamble reporting better than expected results in its latest quarter. The company's new CEO looking to turn things around after slowing consumer spending led to sluggish sales in 2025. P&G's CFO joined opening bid to discuss the latest results, the state of the consumer, and more.
I would characterize quarter two as a quarter that sets us up for growth in the second half of the year. Why do I say that? The business outside of the US is growing 3%, so growing actually very well. We have Latin America growing at 8%, China growing at 3%, Europe in aggregate growing at 3%. Our Asia, Middle East, Africa region is growing at 2%. So you see the growth outside of the US is consistent and broad-based with all of the innovation, all of the interventions on the commercial side, all of the interventions on the go-to-market side that we started about 12 months ago are taking hold and delivering as we expected. The US is a bit unique in the quarter that we just completed. We had a significant inventory build in the base year. So about a year ago, we had 2 port strikes and a hurricane in the US, which led retailers to build significant inventory, specifically on our household care business, and consumers built pantry inventory. So those led to a weaker shipment quarter in the US and in aggregate to the result that you see for the quarter. The exciting part is the innovation plans and the commercial plans that we have started to execute in the US and that we are executing across half two have the same characteristics as the plans that have led to growth outside of the US. So we're very confident that they will also lead to an inflection on the US business. And again, if you take the base effect of the inventory loading out of the quarter, we would have already have seen growth. So this is now a matter of time to emerge in the second half. There are always things that can negatively affect the business. So we keep our guidance range, both on the top line and the bottom line, but we're confident that we're on the right path.
Ajay, within your outlook for the year, again, reaffirm that those top and bottom line outlooks. How important is it that the U.S. starts to turn the corner, that U.S. shopper that has been worried about affordability when they go to the grocery stores, how important is that consumer to you delivering on your outlook?
I would say that the underlying consumption that we see of P&G categories has to sustain. If you take out the pantry loading, over the last 3 months, the P&G consumption would have been about 1.5% to 2% in terms of value. So at a minimum, we expect that consumption to sustain. If we are successful in the execution of our commercial plans and all the innovation we're launching in the second half in the US, we feel pretty good that we're going to be able to do that and hopefully a little bit better. So that's an important part of the guidance range. The other part of the guidance range is that we obviously want to sustain the momentum that we have created outside of the US. But the range we have communicated at the beginning of the year is fairly wide, given the volatility and given all the unknowns that we see around the global business. But the US is important, not a material step change in terms of underlying consumption, but sustained momentum outside of the US. Both components would lead to a good outcome for the fiscal.
Consumer products companies have been taking some heat recently, Andre, on just continuing to shrink the sizes of what they sell and raise the prices. What do you say to that?
I say the categories we are in are daily use categories, and performance is very important to the consumer. If you do your laundry, you want your laundry to come out clean and smell nice the first time. If you use a diaper, you want the diaper to work overnight and not cause every skin irritation. So the products we sell are used frequently, and the performance of the product is very important to the consumer. And the consumer is a very diligent judge of value. And value in our categories really is defined as the product performance, the packaging execution, how well we communicate the performance and how we execute that in store and online, relative to the price that we're asking the consumer to pay. If that balance is right, we see the consumer choose P&G brands, and we see the consumer even trading up within the P&G portfolio because they like the promise we make on better performance, they trust the brands, and they trade up to a higher order proposition. The other element I would tell you is critically important for us to offer the consumer choice. So we offer choices in terms of different tiers. If you want the super premium diaper, we have Swaddlers. If you want the mid-tier diaper, we have Baby Dry. If you want a value diaper that is closer to private label pricing, we have Loves. And we need to be competitive versus the next best competitive offer in all of those in terms of value. And again, performance relevant for the consumer relative to the price we pay. So my simple answer is I think the consumer is a diligent judge of value. So it's our job to keep that equation in equilibrium. That's why we start every conversation with the consumer at the center. Are we delivering truly irresistible superiority relevant for the consumer? And value is a part of that superiority.
Andre, I don't know if you're following the World Economic Forum in Davos. We're getting a lot of interesting headlines on the state of the U.S. economy. President Trump saying that he thinks the economy is growing 4 to 5%, can continue at that growth rate. NVIDIA CEO Jensen Huang saying 6-figure jobs are being created from AI data centers. When you study the U.S. consumer and the health of that shopper, is the consumer as strong right now as some of those numbers or some of those headlines would suggest?
Well, those headlines are certainly exciting. What we're seeing and observing is growth in our categories in the US and outside of the US, albeit at a slower pace. So if you look at our categories, they have grown in the past 3 months in the US somewhere between 1% and 2% in terms of value growth, more flattish in terms of volume growth, which is about consistent with what we're seeing in Europe. And is slower than what I would characterize as the typical growth rate that we see in our categories, which is more in the range of 3 to 4%. Part of that is base period, but part of that is just slower consumption, and the consumer is choosing to be a little bit more diligent in terms of using up pantry inventory, maybe dosing the product a little bit more carefully. Maybe making choices in terms of how frequently they use. None of this is untypical. None of this will sustain. So we firmly believe the category over time will return to 3 to 4% growth. And we view it as our job, Brian, to help lead that turnaround in terms of category growth acceleration, because in many of these categories, we are the market leader. So bringing in new innovation, bringing in excitement to the category, bringing in better performing products, better communicated promises of performance, all of that is our way to initiate category growth. So not strongly growing, more 1 to 2% now, but our job is to return it to 3 to 4%, and typically that would happen over time. You're also maintaining your expectation on how much tariffs will impact the business this year, about $400 million. And I think you offer an interesting perspective on this, given where you spent a lot of your career. A lot of focus now between renewed geopolitical tensions between the U.S. and Europe. Have you crunched the numbers on what fresh tariffs on Europe would mean to a business like P&G, and how much of a hit would it be? Yeah, our tariff exposure came down from the beginning of the year, where it was about $1 billion, to about $400 million after tax now. The P&G team has done I think, fantastic job in dealing with those tariff exposures via strong productivity work, sourcing changes, formulation changes where necessary and possible. And then the remaining exposure was offset with innovation-based pricing, which we typically do every year. We treat tariffs like we treat commodity or foreign exchange rate. We tend not to speculate and run the numbers before we have the facts. So I really don't have a good answer for you. I apologize. But in any case, wherever foreign exchange rate goes, wherever commodities go, wherever tariffs will go, it'll be the playbook for us, the same playbook for us, Brian. Productivity, sourcing formulation changes where possible, innovation and pricing. That's the combination. And to our earlier conversation, carefully respecting consumer value in the process.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wealth.